Hello everyone and welcome to today's webinar, the first by the Fry Group on ethical investing, and a great privilege to have so many of you with us today. As some of you will already know, we've recently launched our own range of ethical portfolios, and so now is a great opportunity to delve further into the topic. Just by way of an introduction, my name is Charlie Buxton and I'm a portfolio manager at the Fry Group based in our Hong Kong office. So just a little bit about how we're going to run today's webinar. I will shortly be passing over to Mike Appleby of Liontrust Asset Management. Just put his hand up. Before I do though, I'm going to give a very brief introduction to the Fry Group, who we are, what we do. As I say, I'll then pass over to Mike Appleby, who will be talking for about 30 minutes just on some of the themes around ethical investing. Now, during that time, you'll see a Q&A box to the bottom of your screens. So please do use that to ask any questions, and I'll do my best to get through those at the end of Mike's talk. So Mike will talk for about 30 minutes. We'll then loop back to me for a 15-minute Q&A, and then hope to be done by around a quarter to the hour. So a little bit about the Fry Group, who we are and what we do. We're a global financial planning firm with over 120 years worth of history and helping clients across the globe and across the generations with their financial planning needs. We have three core areas of expertise, which are tax planning, financial planning, and estates and legacy planning. And between the three teams, we work together to ensure a seamless experience for our clients. Now, at the core of what we do is to provide our clients with financial freedom. And I understand that means different things to different people. But we take our time to find out exactly what that means to you and then structure a plan around that. So, on to the main event. It's a great privilege to have Mike with us today. Mike and his team have been at the forefront of ethical investing over the last 20 years and have worked together at IQVIA Investors, where Mike was a fund manager, Liontrust, and now at Liontrust. And it's at Liontrust that Mike is responsible for the integration of socially responsible investing research into client portfolios. So great privilege to have Mike with us today. And Mike, without further ado, over to you.
Thank you very much, and a good afternoon to all of you. So just bear with me for one moment. So the aim of this session is to help you understand what sustainable investment, what ESG investment is, etc. And I'm going to look at what it actually is, the appetite and demand for it. I'm going to have a look at performance, and then I'm going to be spending most of the time looking at the additional analysis that goes on in this kind of investment style to help you understand what it's all about. So let's start off with the aims. What are the aims of sustainable investment, ethical investment, or ESG? And the first aim for the vast majority of these funds is to outperform the mainstream market by investing in sustainable companies. And the second objective is to use their influence as investors to encourage companies to more proactively manage their business, and particularly in the areas of the environment, society, and how they're governed. So those are the two aims. Now, unfortunately, we work in financial services and there is jargon flying all over the place. The current flavor of term that's used, particularly in the press, is ESG, which stands for environmental, social, and governance. There are millions of acronyms about that, about this going on, but there are only, you just need to understand three approaches that go on and how they actually influence the investment decision to understand what this is all about. So let's quickly go through those. The first one, pretty straightforward. This has been around a long time. So this is ethical investing, and this is really about avoiding certain controversial areas of the market. And your typical investor in an ethical fund wants to avoid arms, tobacco, gambling, and pornography. And maybe now, more recently, with climate change rising up the agenda, you're seeing the avoidance of the extraction of fossil fuels becoming quite broadly adopted as well. So this is pretty straightforward. This has been around since the 70s, probably even earlier than that, in fact. And this is defined by what that fund does not want to get invested in. So that's one approach. The second approach, I'm calling this sustainability themes. And this is all about finding companies in our economy that are going to experience phenomenal, profitable growth as a result of providing things we need and helping us to move to a more sustainable way of doing business. And I'm going to spend a little bit of time talking about this later on, but this has evolved from originally, maybe back in 2004, you saw a lot of single themed funds like Renewable Energy Fund or Environmental Technology Fund or a Water Fund. But there are multi-themed funds out there that have access right the way across the economy. So you can think of this as an approach where it's defined by what it does want to get invested in. And this is very appealing for many investors, is if you can generate competitive investment returns by investing in the solution providers that are helping us to develop in a more sustainable way. That's something that's very compelling. And then the third approach is engagement. And this is where the management of the fund meet with companies that they're invested in and encourage them to manage their business in a more proactive way for the benefit of that business over the longer term. And the kind of things that sustainable investment or ESG funds will be discussing, as well as the usual sort of independence of the board, are they paying themselves too much money, etc., will be things like environmental performance. It might even be to do with human rights in their supply chain, etc. Now, in reality, many of these funds are a hybrid of these three approaches. It's not just one thing going on there. But what's really important is to understand that it's less about what the fund calls itself, because unfortunately, there isn't that much consistency in how asset managers are describing their funds. There are very few funds out there at the moment that are describing themselves as irresponsible or unsustainable. But the key point is to understand to what degree they exclude parts of the market. How high is the hurdle for these sustainability themes and how pure are they? And finally, what is the quality of that engagement they're having? Because there's a big difference between meeting with the company, voting with management all the time, and being really high quality engagement where you're being very demanding of companies and urging them to speed up the pace of change and being really quite challenging to them. To find that out, the fund managers should be very transparent about what they will and won't invest in, what their engagement has been, how they voted at annual general meetings, particularly related to equities. And they should show you a list of all the companies that are in the fund, not just the top 10. And they should be happy to give you, a very detailed answer as to why they hold a specific company, if it's something that you are a little bit questioning about being in that fund. But the key point here is that this, I'm going to call it extra financial analysis, is enabling the fund manager to improve their investment decisions, to make better investment decisions. So let's just talk a little bit about awareness and demand. So we've seen a huge increase in awareness of how we are affecting our planet and the negative impact we're having. I guess the blue planet and plastics was a huge eye-opener for many people, and the climate change activists, so Extinction Rebellion and Greta Thunberg, really rising climate change up the agenda. And here are a couple of pictures down here. The one on the bottom left is Paris last summer, where it had a heat wave, 40 degrees centigrade. The whole place was basically shut down. And here are people cooling off in front of these sort of water fans so they don't conk out. The middle picture at the bottom is a 300-year-old bridge that got washed away in the summer in Yorkshire as a result of an extreme weather event. And also, it's about a little bit more than that. The bottom right is from the BBC, and it just shows that it's still the case that every sector pays men more on average than it does women. So these are all things that are people are becoming increasingly aware of. And I guess the COVID-19 thing is something that has also massively influenced how people are thinking about things. I think if you turned around 4 months ago and said, particularly to our industry, you're all going to be working from home and it's essentially going to be fine. Very few people would have believed you. And I think we're taking this opportunity to realize that when we go back to a normal, it doesn't need to be exactly the same normal as it was before, because maybe that normal wasn't that great. And there is an opportunity here to, I suppose you can call it, build back better. But there's an opportunity to really do things a lot smarter and be able to think of ways that we can have prosperity, but with less impacts on the environment. And we really need to look at these huge inequalities within our society and see how businesses can help in their own way to drive that. So this has resulted in a huge amount of interest in sustainable investment. We're consistently seeing around about 70% of private investors, this is globally, are interested in finding out more about sustainable investment. And I think it's interesting. I started doing this back in 2004, and this is my 16th year of doing it. And when we first started doing this, a lot of people thought we were the sort of crazy bunch in the corner who were really a bunch of sort of tofu eating sandal wearers that really didn't have a place in investing. But over time, I think a lot of people have got that. And there is continued and growing demand for sustainable investment products. Let's look at investment returns, because a lot of people are concerned that by including your values in investment that you're necessarily going to underperform. And there's a lot of empirical evidence to show that this isn't the case. So this is a seminal bit of work done by Frieda et al. Back in 2015. This looked at over 2,000 peer-reviewed journals that looked at the relationship between how well a company is managed in terms of its environmental, social, and governance aspects. And it found an overwhelmingly positive relationship, showing that the better ranked companies in terms of their ESG management quality delivered higher investment returns than those with poor ESG related management. And indeed, so that's the empirical side, but there are a significant number of sustainable investment or ESG type funds, that have been around for a considerable period of time, decades, that are also delivering very competitive investment returns, top quartile versus their conventional peers. So it is possible to find sustainable investment funds out there that are delivering incredibly competitive investment returns. And it's not necessarily the case that you're going to have to give up investment returns as a result of applying this investment style. So how does that work? Because people think, well, how is it possible for these funds to outperform if they can't invest in all the grubby stuff where you make all the money? And I guess the quick answer is there's extra analysis that fund managers do within sustainable investment that helps them make better investment decisions. And that extra analysis tends to fall in two main areas. So environmental, social, and governance aspects. This is to do with the management of the company. This is linked to that last slide. So it's not a surprise that a lot of even mainstream asset managers are working this out and trying to use this to improve their investment decisions. It's interesting because if you think of an industry, it's easy. Most people assume that all those management teams in that industry are the same. Actually, if you go in and look at these kind of metrics and start digging in, you find a huge disparity between companies within the same industry. There are very proactive management teams that are using this as a competitive advantage to outcompete their peers by providing either a much better workplace that everyone wants to go and work for, or much better products in terms of their environmental impact that are going to gain market share. And you also, at the other end of the spectrum, you get very reactive companies that don't like talking about this stuff at all. They don't want the world to change. We believe that this is a really good proxy for the quality of management in that company. And generally speaking, the really proactive companies on this are generally the really well-managed ones as well. The second aspect where they do a lot more extra research is to do with the long-term trends. And I want to talk a little bit more about this, because the idea here is that it's much more interesting to invest in companies that are benefiting from these big trends rather than those that are trying to fight against them. And those beneficiaries of these long-term trends that are driving positive change, understanding that change is something that is worth doing, because the market isn't very good at this. The market is not very good at thinking what's going to happen over the next 10 to 20 years, and they're much better at looking at what's going to happen over the next couple of quarters. So that can give you an information advantage and help you find some really interesting companies where their growth is undervalued. So let's talk about the sustainability trends. So there are a vast number of these, and they're really all about either making our environment cleaner, making us healthier, or the systems that we rely on more reliant. And so you have resource efficiency type stuff, so to do with energy efficiency, increasing renewables on the grid, increasing waste treatment, etc. But also things related to quality of life. So things about improving our lifestyles, about getting better patient outcomes, innovation within the healthcare industry, etc. And then there are other things like cybersecurity would be a classic one. As more and more of our lives go online, it's critical that that information is kept safe. And if you talk to a chief technology officer, which we do regularly, they will tell you the one area that they're not cutting back on spending is to do with cybersecurity, because as one person put it, you only know whether you spent enough when it's too late. So these are all positive structural trends that are going on. And the sustainable investment teams will have spent a long time thinking about these trends that are going on and finding out the companies that are helping to deliver these positive trends, and also finding companies that are diametrically opposed to these positive trends that we're looking for, so that those can be avoided. So the point here about these sustainable themes is that they go right the way across the economy and can help these sustainable investment funds build really diversified portfolios that can, it's not the case that this is just going to be full of renewable energy companies and water companies, which, they're important, but they're not the only show in town. Okay, I'm going to talk about two themes now. One of them is a very big one related to climate change, and then I'll talk about a specific stock. So we know that the climate is changing, and on this bit here, so 0 degrees is what the global average temperature was back in 1890, pre the big effects of the Industrial Revolution. And what we can see here is that the global average temperature has increased by about 1 degree already since then. And the Paris Accord, which is something that everyone signed up to, is trying to cap that global average temperature rise to 1.5 degrees, ideally, if not 2 degrees. And these numbers are quite weird, because 1 degree global warming is quite hard to get your head around. But bear in mind, 2 or 3 degrees is the kind of temperature change that would flip us in or out of an ice age. So these are massive changes that are going on. And, at a 4 degree increase in the global average temperature, it's a pretty horrific scenario. It's a very disrupted world, huge increase in the frequency of extreme weather events, and even quite difficult to grow food in some areas because of that climate change. Now, Carbon Tracker had a look at all the current policies that are in place, and if they were enacted, we're heading for a sort of 3.3 plus degree increase in global average temperatures. And that's not good news. And that's if things get enacted. So the takeaway from this is there are going to be more regulations globally to try and reduce the amount of carbon dioxide that we emit. And this is going to have a really massive impact on investment returns. So if we think about who are the winners potentially and losers of this energy transition to an ultra low economy? Well, renewable energy is clearly a winner. And it's really interesting for me to see that when I started doing this, renewable energy was very expensive, required huge amounts of subsidy. But now in many areas, wind and solar are the cheapest form of new electricity generation that you can possibly build. In the UK, onshore wind is the cheapest form of new build electricity. And in the US, solar has become the cheapest form of new build electricity generation by a considerable margin about 18 months ago. And we just saw a new solar project being bid at under $2 cents per kilowatt hour. Nothing can compete with that. That is super, super cheap. So there are huge positives in here. And I'll talk a little bit more about that. That doesn't necessarily mean you want to buy every renewable company that's got renewable or solar in the name, because some of those business characteristics aren't that great in terms of profitability. But if we think of where the global emissions are coming from, broadly, they come from 5 areas and they're roughly equal. So one of them is to do with power generation. One of them is to do with industry. One is to do with heating and cooling buildings. The other one is travel. And the final one is agriculture and land use change. They're not all quite 20%, but let's just say they are. So if we woke up tomorrow and the whole world was powered by renewables, we would have reduced our emissions by, it would be about 24%. And bear in mind, we've got to get our emissions basically down to zero as soon as we can. So there are a lot of other things going on aside from renewables. Energy efficiency is somewhere we see huge opportunities. So this is a double whammy in that you are reducing the amount of energy that's being wasted by your customer and saving them money. And in that process, you also happen to be reducing emissions. So there are some interesting things here in super efficient air conditioning, in LED lighting, which is a very efficient way of doing it, and businesses that are all about finding efficient ways to manage buildings, essentially, and reduce waste and save money. We see huge disruption in transport, and we are seeing a shift away from the internal combustion engine to hybrids and electric vehicles, and we see many opportunities related to that and in the supply chain. And then there will be losers. So incumbent industries that are very carbon intensive, where there are lower alternatives, are going to continue to feel the pressure, and a lot of them just simply aren't going to make it. So that's an example of a big trend. I'm sorry that I've had to go through this incredibly quickly, but to give you some ideas of how sustainable investors are thinking and how that's affecting the investment decisions that they're making. I guess the other way is to flip it on its head. If a fund is being run by a fund manager who's not thinking about climate change, then good luck. Because it's happening, and there have been huge changes that have already happened in the last decade. And I think it's just part of good management to be on top of this, to have given it some thought and to make sure that you're not going to lose money as a result of not having thought this through. So let's think about the investment process and how we include this in the investment process, because it's one thing to go and find lots of lovely companies that are going to save the world. It's another thing to build a portfolio that's actually going to generate decent investment returns. So we believe there are four aspects that need to be right for any business to, or any stock to outperform. Two of them are sustainability related. One of them we've talked about, the trend, so the right side of that theme. The second one is to do with the quality of management. So we want them to be proactively managed. But also we believe that you need good business fundamentals. This is essentially that the business will be profitable. And lastly, you don't want to pay too much for this business. You want to see some considerable upside over like a 5-year view for that to be a decent investment. And it's when all four of those aspects are aligned, that's what we would define as a sustainable investment. I'm just going to look at a specific example now. This is quite prescient given what's been going on with looking to find a cure for COVID-19. So the amount of money being spent on healthcare is absolutely immense. In the UK, it's nearly 10% of GDP, but in the US, it's a whopping 18% of GDP gets spent in the US. This healthcare expenditure is expected to continue growing for around about 6% a year. I'm going to concentrate on the US now, the US market, while we're going through this. And we're seeing that the big pharmaceutical companies, the amount of drugs they're finding that work are falling. So their productivity is falling. So we need innovation. We need something that is going to come up with, we need novel ideas, better ways of getting patient outcomes that are good, but in a cost-effective way. So are there any businesses that are helping us to achieve that? I want to talk about drug trials. So let's say we all invented a drug trial. Let's say someone had stumbled upon a cure for COVID-19. Before we were allowed to sell that, and incidentally, I don't think anyone's really going to make any profit on that, or not a meaningful one. It'll be done at cost, but just run with me on this one. We would have to go through clinical trials to prove that these drugs work, and you go through 3 phases, and there are more and more people in the trial as the phase becomes more successful. They're pretty complicated to run these, and the costs are, looking at over a 3-year period, the phase 3 trial alone that went on to be approved costs anywhere between 4 million and 400 million just to do the trial. So this is a significant number. I'm not saying it's huge compared to actually developing the drug, but there is a big cost here. And what we found with these drug trials is that about 80% of them go over time and over budget. So they're incredibly inefficiently run. Now, IQVIA is a really interesting US company. It's a 30 billion market cap. They have data on prescriptions in the US, every prescription in the US, and whether people are taking their medication as well. They've used that to design and plan these drug trials. So you want to be able to find a certain number of candidates that have a certain number of other presentations in terms of diseases, etc., to make sure that there aren't interactions with other drugs they might be taking, etc. And that designing of it is something that IQVIA have become incredibly good at. And they even run these drug trials as well at these centers. And what we've seen is they are much better at doing this than the pharmaceutical industry. And as a result, they're winning huge amounts of business by developing these drug trials much quicker and much more efficiently. And this can make a big difference. This can make a change in getting a drug to market, say 3 months quicker than it was possible in the past, just because they're very clever at monitoring and planning and monitoring and running these drug trials. So if we go back to those 4 characteristics that are key, so the whole business is about this. This isn't 5% of the business on the side. So we're seeing 7% top line growth. It's a well-managed company, and it's making proper investment returns of over 25% return on invested capital, and we believe there's significant upside. This isn't a recommendation to buy a stock, by the way. It's just an example, just to be clear. The other thing, I've just got a couple of minutes left. I wanted to talk about extra reporting that happens within these sustainable funds. So it's very common to see the amount of the fund that is exposed to these different positive trends that I've talked about. And also, you should be aware, if you're not already, of the United Nations Sustainable Development Goals, SDGs as they're called. So these are internationally agreed targets to meet by 2030. They replaced the Millennium Goals, and they're quite a useful vocabulary for sustainable development, which can be a bit tricky for people to get on board. But you are seeing in annual reports and accounts of companies, and also in increasingly in funds, exactly what exposure those themes have to these different sustainable development goals. And you should be aware of that. And then you're also seeing extra information, particularly to do with carbon. So this, for example, is a fund, and the companies in this fund emit 88% less carbon dioxide than the market in which they're invested. Over a third of the business is invested in what are called solutions providers, which are reducing CO2, and nothing is invested in companies that are extracting fossil fuels. So this is the sort of data you're beginning to see. And there's an important investment impact on this lower emitted carbon if, as we talked about earlier, regulations come through that put a higher price or a price on the cost of carbon. This fund, the margins will be far more resilient than the market as a whole, because what happens is if you have a cost, you pass it on to your customers. If your customers are happy to absorb that cost, then it's no impact on your margin. But if they don't, you have to take that cost and it'll hit your margin. And you can see here that essentially there's 88% less carbon cost to pass on to your customers. So the margins will be very resilient to future regulation on climate change. So just a quick summary of what you get in these sustainable investment styles. It's investing in companies that are essentially making our economy cleaner, healthier, and safer. The fund manager is engaging with businesses to encourage them to be run more proactively. You're avoiding controversial industries. And it is possible to find these funds that have been running for considerable periods of time that have got very good risk-adjusted returns. So in short, sustainable development investment can certainly deliver more. I will stop there and see what questions we have.
Mike, thank you very much for that. Sorry, I'm just dealing with a handover now. Hopefully you can all see my screen. The questions have been coming through, which is great. So thank you very much indeed for those. We've got around 10 to 15 minutes now, so I'll get straight to it. Mike, the first one for you is, as most large companies are doing something unethical, does this mean a natural bias towards medium and smaller cap in an ESG fund?
Yeah, it can be. There's a whole plethora of these investment types. And one of the things I'd like to say is the press talk about ESG funds or sustainable funds and talk about them all being the same thing. They're not. So, but you're right. Typically, there might well be a mid-cap bias. But it's worth saying, we're not saying these companies are absolutely perfect and they're not doing anything wrong. We just reckon that they are, much better than average in the market, and those problems that there are, we're engaging with them to make things better. So you can have some funds do have a sort of mid-cap bias, but it is possible to get some bigger blue chips funds in there as well. I guess it all depends on your appetite and what you want. Some people will like the fact that they've got larger cap companies in there, blue chips, if you like, whereas some investors really don't want to invest in a lot of these big multinational companies, because they feel that there might be parts of them that are providing solutions, but maybe a lot of the business is actually not really helping us, particularly from a sustainability perspective.
Okay. Thanks,
I hope that answers your question.
So our next one, it's an excellent question from Andrew. What does a department, so I think we're talking about an internal department, do about promoting ESG within firms? What's the sort of best approach to that, do you think?
Are you talking about an advisory service or?
I think the question is just focused on sort of, if you're a company, whatever that sort of does, how do you go about promoting ESG from scratch, let's say, into something which has got some meaning for the company?
Well, every company is different. And I think the first thing to do is to think about what are the most material impacts that business is happening, and you need to address those. And it's different for different businesses. So I'm not saying anyone is, but if you're working in resources, let's say, and you're all about extracting, minerals, etc., the key things that you need to look at are safety and managing political risk, and particularly bribery and corruption. Those would be things that are really, really important for you to address. If you were in a media company, a lot of it's about corporate governance, and it's about sort of reining in typically the founder who might have become a little bit of a megalomaniac by that point. But certainly in terms of what I see as within investment, I think a lot of it is about understanding that it is not the minority of people who are interested in sustainable investment, and by having open questions about it, you're much more likely to elicit a response from them about what they really feel and what they want to invest in.
Sure.
And I would say it's not always the case. There are some times where it's purely an ethical reason not to do something, but the place to start in any business are areas that have got a really good business case. That's the place to start, because that's where you're going to get the traction, and that's where, if you can make a business case to the board that we need to improve the way we hire people to make it more diverse because we're going to be able to attract better talent, blah blah blah, you're going to get somewhere. Much more than some sort of random pet project that you become really interested in, which I'm sure might be relevant to you in your life, but you just got to think about whether that's relevant to the business and what it does.
Sure. Okay. Thanks, Mike. So next question, and it's another great one from Steve. The IMF warned a few days ago that it considers markets to be disconnected from the reality of a likely COVID-induced correction. To what extent do ESG funds follow the general trend, or is there scope for them to buck the trend? What might the next year hold for the main ESG funds?
Yeah, okay. I mean, again, there are lots of ESG funds that are positioned in different ways. It's not just one fund, but certainly I think the market has been struggling to work out what's going on. That's been reflected in volatility. You have sort of risk on days, risk off days, depending on what comes out. But I think that if you're looking over a 5-year view, which is what we're trying to do, and you ask yourself, are those trends that I talked about on that slide, for example, are they likely to become more entrenched or less entrenched over the next 5 years? I think they are much more likely to happen now that we've had a crisis and people have realized that a lot of people have reassessed what they think of things, etc. And I think this idea of purpose and this idea of trying to achieve something other than just making money is something that I think will resonate. And so, I think, listen, like a conventional fund, there are some great ESG funds or sustainable investment funds. There are probably also some pretty rubbish ESG funds as well, just as there are some really great conventional funds and some not so good ones. So I think that when you're thinking about this, certainly as far as investments go, you should be looking at the risk-adjusted returns. You should be looking at how long have the team been together and how are they running it. And I think that sustainable investment and ESG, if you like, is going to continue to be something that people are very, very interested in. Sure. And that the press like to have a snipe at every now and again as well.
Okay. So we're not the victim of that. Mike, next question for you. What's your view on fossil fuel companies with a net zero carbon ambition? Are they still investable under an ESG mandate?
It depends on your mandate. I think that it's an oxymoron. I think I wouldn't invest in a fossil fuel company. We've got companies saying that they're going to be net zero by 2050 that are listed in the UK. All that means is that they will be complying with the law, and you don't really get huge points from me on that. I think it is really interesting to see the amount of capex that's going into renewables from many of these big oil and gas companies. Nearly 17%. Equinor, which used to be Statoil, is happening, but ultimately they're still producing a product that we need to wean ourselves off. So So to answer that, you can get exposure to, ESG tilted funds that do hold fossil fuels, and for some people they like that, or you can get ones that avoid it. For me personally, sitting down in front of Shell and asking them to become a renewable energy company, when Shell know and you know that you're not going to sell the shares, for me personally, I think is a total waste of time. But there are people who they think that's cool. So good luck to them.
Mike, probably got time for just one more question, I'm afraid. Yeah. I will do my best to get back to those of you that have already asked questions as well. But just time for one more. How do you deal with companies whose ESG score is worsening, and when and why would you sell it?
So different funds have different things. The way we would do it is we have a cutoff of what the company does and how well it does that business. And basically, we would downgrade them if momentum was going the wrong way. But ultimately, if it got to the point where we didn't think that company was adequately managing those issues, having engaged with them, we would divest. And it does happen from time to time. I mean, a long time ago, we were invested in Amazon. We spent a lot of time talking to them. They were not very receptive then. This is maybe 5 years ago. And we divested from the stock because we didn't feel we were getting any progress. But my understanding is they have had a complete turnaround, and certainly if their adverts on telly or anything to go by, they're now really concerned about their staff. So potentially that's something that is worth looking at again. But I think if at the point at which you feel the company isn't adequately managed, that would be the point to sell.
Okay, thanks, Mike. I'm afraid that is all we've got time for today. But I mean, for me, I think the key takeaway was that if anything, COVID-19 has accelerated some of the trends that are already in place. So, Mike, thank you for such an interesting and insightful presentation today. And thank you, everyone, for your questions. It's been fantastic to see so much participation from the audience. So thank you very much for that. If there are any questions you've got on today's presentation or any other elements of your financial planning, please do get in touch. You should see, hopefully, if my tech's good enough, a link to your local offices. So you'll see UK, Belgium, Singapore, Dubai, and Hong Kong. So as I say, please do get in touch with any questions off the back of today's presentation or any other broader questions around your financial planning needs. But in the meantime, thank you again for joining us today, and we hope to hear from you all very soon. Thank you.
Thanks very much.